we always tell our clients, best deal. What is a best deal? How do you know if it's a best deal if you don't take it? It's all about your credit. It's not about the score. Score means absolutely nothing. At the end of the video, I'll be doing a giveaway, so stay tuned. Well, my name is George Wong. Been in the automotive industry for almost 17 years and going. Besides the credentials, so certified banking credit analyst, certified Equifax credit professional, I also do mortgages too. While back, I was even pretty all over the place a little bit, I would say. I even did as a technician apprentice for 5.5 years or so.
People often said that a high score actually promise you a best deal. Do you think that is true?
No, it's not true. We always tell our clients, best deal. What is a best deal? How do you know if it's a best deal if you don't take it? Right? Because it's such a very subjective thing. Maybe a lot of people think or feel in their mind, getting certain thing actually they want is a best deal. But how do you know if you don't take it, if that is a best deal? Right? So meaning if someone like yourself or anybody else out there offer, you don't take it and you go somewhere else, and somewhere else was, let's just say in comparison, is a lot worse, well then you just lost that deal. Or the best deal, quote unquote, right? So is that really a best deal? Or in reverse, you'd really take that deal and then there was something, you found out there was a better, well, at that moment, maybe that is a best deal. But later on, you found there was a better deal. So how do you know if it's a best deal if you don't take it?
So if two people, they walk in with the same score, say around 500 something, would they get like the same raise or would they get like the same payment actually?
When some clients, they do, I guess, compare, my friend maybe 600, why am I 700, I'm 500, how come that person, you're right, got a better rate.
Right.
As a certified banking credit analyst, I deal with a lot of credit portfolios related, whether it's corporate or personal. But summarize, everybody's situation is very different. Just because you're 500, I'm 500, well, do we make the same income? Are we the same age? Car-wise, product-wise, does actually affect the interest rate itself. And also mainly is really your credit history will dictate and determine what the lender or I myself as a credit analyst, the risk that we're taking, right? So there's always a saying, and I always tell my clients, know the devil, then the devil you don't know. So someone, let's just say, I'll give you a very good example. Someone that come, we call it the newcomer, anything less than 5 years, with 9 work permit, visa student, etc. The default score can sit around, on average, about 680 to almost, I've seen like 720, but absolutely no credit history. Versus someone maybe only 600 score or 580 score, maybe a couple late payments, but those late payments maybe is Rogers. Maybe it's only $10, $15, $20, whatever it may be. But the lender can see the portfolio. Well, this client can handle maybe like a $50,000, $60,000 loan. 1-2 missed payment, maybe during COVID, justifies. I think I have more comfortable lending more money than someone that I don't even know if I lend $10, will they pay me back?
Right, it's all about the risk of lending for the lenders, right?
The credit itself, it's all about your credit. It's not about the score. Score means absolutely nothing. Interest rate all based on, or it really truly dictates based again on your credit. Okay, credit would be again another probably section we'll have, and we'll talk in depth what kind of changes it does to your approval, the financing, right? But it's really just based on your whole entire situation, from income to your status, how long you've been working there for. Someone could, the approval rate could be a bit higher. Someone versus, been there for 20 years, compared to someone just started within, 1 month still in probation, right? Someone with maybe, has a Canadian citizen or PR, for someone's like just a visa student, work permit. Those are huge factors.
let's talk about down payment. Is paying a big chunk of money down the best move when it comes to getting your first vehicle and when you don't have the best credit score necessarily?
It's if, good question. A very good question. Putting down or not is a very subjective thing. Okay, so a lot of people have different point of view to it. Some people would be like, okay, put more down just to lower their payment, because a lot of people feel that, oh, I'm paying some interest, paying down, putting a large down, they'll pay less interest and all that. In theory, yes, it is. Right? If you want to look at it like that, yes. But if you look at grand scheme of things, two things I always look at. One, again, why would you put your cold, hard-earned cash on a depreciating value? Take that money, invest. So in the financial world, we always say, when you have these kind of cash flow sitting around, invest it. Put it on stocks, put in a lot of things right now that there's a lot of Mark Carney just went to China, talking about bringing more EVs in. There's a lot of things are changing. I feel that using your cash money to put on certain products far worth more than putting in a car. But down is also something that brings the risk less. Down for lenders, right? So very good example. If my credit is 500, not the greatest, I want to borrow $40,000 because after taxes, after cost of borrowing, after fines and fees and all that, because I want a Toyota RAV4, for example. Then the lender's like, okay, no problem. I'll charge you based on every situation. I'll give you 20%, for example, 19.99 like that, right? Then because you're borrowing that much money. Now watch, what if someone turns around and say, you know what, 40,000, I'll actually put $30,000 down. You're almost paying off the whole car. So then the lenders now, by giving only $10,000 loan, the risk is a lot less. Then guess what, the rate will be a lot lower because I almost have nothing to lose. So let's bring down that a little bit more. What if now the cost of borrowing, I'm only borrowing at $1? You're giving $39,998. You know what? I'll just give it to you. It's $1. I'm going to charge you with $1. You see that? So the more, that's why in the mortgage world we always say why lenders always have that buffer of 20% down and so on and so forth. Is for the exact same reason. Bring the risk less down, your debt's down, we call it the TDS, GDS, and all of that.
So down payment actually matters if you have like a pretty bad score and then you want to lower your rate for lending. And but in other words, it also, it's kind of like you're giving up the chance to invest your cash into something else that might give you like a bigger return, right?
So very situational again, right? That's why I say I look at 2 points. It really depends on your situation, depending really what the lenders do come back with.
So for subprime buyers, what is down payment actually doing for them, and how does it change the risk of the deal?
The client can comfortably come up with a small down, whether even 500, let's just say. Every little bit helps, right? Maybe 500 is not obviously a lot to a lender, but at least to a lender that shows some sort of commitment. You really want to do this, it may not be a big impact to the whole financing loan, obviously, but we always say something's better than nothing, right? So comfortability, our job responsibility is to find out what the clients, their comfortability, what they can truly afford, what they can truly really do, and we'll help them navigate that.
Most people, especially subprime buyer, they only focus on one thing, which is their monthly payment, because it is taking a big chunk of money off their paycheck every month for the following 5 to 7 years. But if we are focusing on monthly payments so much, what are we missing here?
Because back to again, why clients so focus on the monthly payment or bi-weekly, weekly doesn't matter. It's because at the end it's what they really truly can afford or what they're willing to maybe pay, right? But again, that's where part of our process here would really want to find out, okay, what is your true budget versus walking to some other places, and maybe your budget in your head was 500 and then now you end up walking out 900. And this is why a lot of people in the subprime category, because they got enticed with emotional buying. They got enticed by, like, we just had a recent client came from a dealership, obviously I won't say who or which dealership, but they came here and want to refinance it, lower rate, lower payment, because they said they upfront said, I made a emotional compulsive decision. They showed me all the bells and whistles and I fell in love, and then after a year they're just debts accumulating, and then they came to seek for help, right? And then at the end we found a solution for them, right? But yeah.
So people often buy impulsively.
Oh, 100%.
End up with like a payment that they can't really afford.
100%. Yeah, and that's why we are here to help the client to navigate their situation. Well, this doesn't make sense. Why would you do that to yourself? You are in this position today. It is because of that, whether it's lack of education, mindset, mentality, discipline, many things. But that's why here we usually spend good 3 to 5 hours with clients, just on even finding out a lot of things back and forth, going through the credit, very detailed and in depth, so that they have a better understanding. A big handful of them would always come to us for solution when they're stuck in, payments are high, they start to maybe can't afford it. Usually the two things, one common one is, again, what we spoke earlier, they walk out from a dealership and, oh my, what did I just do? Secondly is probably in their life, things have changed. I've seen many clients, whether it's related to family or work,
like that, to everyone.
Exactly, which affected their financial, and they would come seek to us, and a lot of refer by banks too, and clients, even law firms too. Hey, if you're in this kind of situation, go see them.
I want to follow up a bit on subprime buyer, because I know that at SAF we work with a lot of subprime buyers here. So do you have any suggestion for them, and what is the best thing they can do when they want to acquire their first vehicle?
My honestly advice or recommendation, and I've been in the industry for over 17 years, and I can truly tell you that it really depends who the person is working with you or for you, or I guess salesperson. We all know, when we go to dealerships or used car, they have this kind of, afraid or defensive wall. It's like, oh, this guy scam me, lied to me,
Yeah,
what if
it's
sell me?
intimidating.
Very, right? What if I got a lemon, stuff like that. It really, I think what advice can give is really do a lot of research about not only the company itself, because then the company is the reputation represents behalf, but the person who you'll be working with. Do they have honesty, integrity? Are they very transparent? And mainly, are they licensed and certified? I notice a lot of business out there imposes a lot of credit rebuild with auto loan, do a lot of different kind of stuff. But has any client ever challenged, well, are you certified? Are you qualified? Not that it's needed to do what they're doing, but then where would this information come from then?
What is the biggest differences between, say, if I go to like a certified credit consultant, or if I go to someone that is not certified? I mean, they can still sell me a car, so...
Correct. they can all do their what they're due, at best doing selling the cars. I guess the difference is then you have to find out who has more best interest in you, okay, as a client, okay? So is it sales best interest in their pocket, commission, or a credit consult more so really consulting with your credit? What is best for you in terms of your current situation and what will help you in the future? So, in the mortgage world, there's always a code of ethics. It has to be always best interest in client. You always have to do whatever it is, whatever you do is legally best interest in the client, not for the bank, not for your broker, or not for yourself. Does it make sense at that situation for the client to do what they wanted to do at that time?
So it matters whether they are for the clients or for themselves or for the lenders, right?
Correct. Right. A lot of what, to really finish that off, a lot of clients will come in and, or anywhere, or even including maybe yourself or myself, hey, I want what I want, I wish I want to get this and that, never knowingly really what is your true affordability, right? A lot of people that I notice, they want the car, but they can't even afford an oil change because a BMW might cost a $200-300 oil change.
Yeah,
so what did they go to
factor
go?
in a lot of maintenance costs.
Absolutely. Winter tires, rims, maintenance, all of that. They go to, third parties, for maintenance. Not that you can't. You absolutely allow. You can. It won't void any warranty. But it's just back to, again, your true budget, your true affordability, right? And does it make sense to do something like that? Because in the automotive industry, and this is well known, a car is a depreciating value. So why would you put so much in a car that's going to depreciate, right? So these kind of, conversations, no dealership, no one would. I seldomly know or even met anybody would even talk or even share ideas the way we, share ideas with our clients so that they have a better understanding.
Yeah.
Right.
When it comes to affordability, what are something that people completely miss when they try to get a car?
Lot of clients, what I've noticed is they come in with a budget thinking based on what they make, and they just use that number. But they really forgot about, this is a rule of thumb, okay? It's called PTI. You guys can Google it, search what that means. So lender has a rule of thumb where they use a calculation based on your income, then including insurance, your car, your gas, entertainment like rent, food, movies, groceries, all of that. There's a percent.
All of that in.
Absolutely. Then the lender would then feel adding on top my side of credit, the risk two and two come together to see if what is the true number a client possibly can afford. So client come in, completely miss all that. They think they're making $1,500 bi-weekly, maybe 3,000, 4,000 a month, bring home maybe, 2,500. They think, okay, I have that kind of budget. Well, what about gas? What about maintenance, etc.?
I see. So there's much more than your income when it comes to
absolutely
getting approved for your loans.
Absolutely.
What is the biggest mistake subprime buyers make because they just assume that they have a very low score and they don't have any options elsewhere?
The biggest mistake, I wouldn't say it's a mistake. I mean, a lot of times these kind of, anything with credit or financial is very unfortunate. The education in any country, they don't teach people that. And a lot of people in the financial industry has, whether they try to vote, they try to push, have, the educational system educate them. It's very unfortunate. I don't know if I'm allowed to even say this here, but the world revolves with debts. Country owes country money, money owes money. That's how banks exist, credit card exists, and rates and all that exists. If everybody walk out with a perfect score, don't need to borrow money, then there's no banks at all. There's no need, right? So I wouldn't say it's a mistake. I think it's just a lack of education, lack of knowledge, and which leads them to where they are today as in the subprime category. Clients coming in again because of that, not knowing that kind of knowledge. They're just knocking on door, hitting a wall, not sure what it is. People say this, say that, but again, back to, well, are you qualified? It's almost like talking to a doctor that's not licensed.
Oh, that's bad.
Do you really want to hear an advice from that? I'm not saying they're wrong. They're probably a super doctor in back home or in their country or whoever may be, but that is the difference. I strongly believe, clients going anywhere really should do their fact check, do their research, who they're really working with, who they're really talking to, right? And is it really, do you feel they're really best fit for you, right? I think that's really very important. I feel that clients should do that extra homework. Google review is a big thing too. It gives you an idea, right? When you want to look at a restaurant and they're like 3.9 already, you're like, may not want to go. Doesn't mean it would be a bad experience for that person. May not be, right? Because those are based on experience, right? But I think it's enough to say that at least you would feel, let me search other places first, right? Before if I really want to go there, right? So do a lot of research, do a lot of homework, make sure, who you're talking to, they're, licensed or certified. Again, it's not necessarily you need it. It's not necessarily it needs the industry, but it's something I feel that, it's a peace of mind. It's a very peace of mind for a client.
It's a very
right?
big decision after all.
It is. End of the month, I'll be giving away $200 cash to one lucky person. All you have to do is like, share, subscribe, and comment and tell me what the money is towards. Let's build a better credit together.